Hello and welcome back to our topic 46, Alternative Minimum Tax, AMT for short. This is also a highly specialized area of tax that you may not have had much experience with, so I look forward to getting all your insights. Alternative minimum tax, what we're going to cover are the mechanics. What are the preferences and adjustments that you can do? Additionally, we're going to talk about any items that can be excluded and any deferral items, what credits can be created and used, and the limits on those credits. Then we want to apply the AMT to businesses and trusts. As you'll recall, our previous lecture was on trusts, so you will definitely recall that. Then you will have some planning strategies. So once we do all of that, so let's just dive in and get right into it. So the mechanics. So basically the AMT is designed to prevent taxpayers with excessive deductions from paying too little tax. So in this case, what they're trying to do is just say, hey, just because you have a lot of deductions doesn't mean you have to pay such a little bit amount of tax. Okay, then it requires separate calculations of taxable income and application of different rates. So what that means here is just because normally when you get to this level, you have quite a bit of taxes and you have quite a bit of income. And so basically what they're trying to do is say you have a separate calculation for that taxable income, and that calculation will be applied at different tax rates. The taxpayer will pay the greater of the AMT or regular tax, and most often than not the AMT is greater because it uses higher tax rates. And then it limits the effectiveness of many tax planning strategies. So this is what came out to say, just because you have the ability to plan ahead doesn't mean you should be able to pay less taxes. So there are preferences and adjustments. Some preferences include permanent items that are taxable or non-deductible for AMT purposes. And so P is for permanent preferences. Some examples are state and local taxes, 2% of your miscellaneous itemized deductions. Then some adjustments. Adjustments are mostly timing differences, maybe incentive stock options and depreciation. So that's the difference between preferences are usually permanent and adjustments are based on timing differences. Then you have exclusion items and deferral items. So exclusion, basically they're not deductible at all. So if it's exclusions, you're not deductible. Any type of personal exemptions or preference items. But there are some deferrals. And they're usually because of the timing differences, and basically the adjustments that we just talked about are those deferral items. Then there is a lengthy calculation to start. You start at adjusted gross income, then you subtract casualty losses, you subtract residence interest, you subtract charitable contributions. So this subtraction is basically most of the stuff that's coming from your itemized deductions, your Schedule A. Okay, then you're going to add excess depreciation. You're going to add your interest on private activity bonds. You're going to add back any difference between the exercise price and the market price for any incentive stock options. Then you're going to subtract the alternative minimum tax exemption amounts, which these amounts change. And then whatever you get, you're going to multiply by 26%. For the first 186,300, and then 28% for any amount. And then what you come up with, this is usually very easy. I would highly recommend to do this in an Excel spreadsheet. Just get that set up because you'll be using it quite a bit for your clients. And it's just basically you would put anything in Excel, you maybe color it in blue to show that that's a data entry cell. So you can go ahead and plug and play and use that to calculate the AMT and kind of give your clients a quick and dirty, hey, this is what it might cost you from an AMT perspective. So just to help out in tax planning, at least that was my experience, and that's what I did, and my clients loved me for it. So then you have credit usage, right? So you create any AMT paid in a given year due to the deferral, not elimination, or the acceleration of income can create an AMT credit. Then that credit can be used to offset regular taxes in future years. The hard part is this credit is very difficult to get. There's several stipulations and I haven't seen it used quite often. But the limitations is that the AMT credit cannot reduce the regular tax liability below the amount of the AMT tax liability for that year. So hence why it's not used, because usually the AMT credit is not as much, and the AMT tax is higher. So we have some examples here, and you will see that Bob's regular tax liability for the year was $100,000, but however, due to the exercise of his incentive stock options, he will end up having to pay his AMT tax liability, which is $120,000. So how much AMT tax credit will Bob carry forward to the next year is just the $20,000. So in this case, it doesn't seem like there's any exclusions, so it looks like he can carry the $20,000 over. Go, Bob. Now we have C Corps are also subject to AMTs, another disadvantage that we didn't talk about earlier, right? So, excuse me. So you use an exemption amount of about $40,000 and at a rate of 20% after you calculate the alternative minimum tax. And the exemption amount is reduced by 25% of the amount by which the AMT exceeds $150,000. Again, with all these numbers changing regularly, I highly recommend an Excel spreadsheet with all of this information with if functions, sum if it equals that, multiply by this if an amount increases. And if you don't know how to do those, lynda.com, lynda.com is, you just YouTube her videos. They have a ton of Excel videos just to show you how to do sum ifs and multiplications if this, and that's what would work great for all of these calculations, and that's what I used in industry. So if you are exempt from AMT for small corporations, if you have under 7.5 million in average receipts for 3 years, and if you have under 5 million in gross receipts for corporations in existence under 3 years. So also keep that in mind. Once you're a startup, usually those taxes then start kicking in after the 3rd or 5th year, so you want to be careful. Then trusts are also subject to the AMT rules, but a beneficiary may not report different trust incomes or expense for regular tax and AMT purposes, so they have to be the same. And the trust might have to pay AMT if the trust accumulates that income. So just keep that in mind as well. And then for planning strategies, if a taxpayer is facing a possibility of being subject to an AMT, maybe you want to accelerate the income or defer deductions, and these actions will increase the regular income tax for the current year, but you might avoid the AMT, because remember, once you start with the AMT, you're more likely to continue with it, and that higher rate will kind of keep going for you for a long time. So that's the end of our AMT discussion. Hopefully this clarifies some items. Don't forget, I would highly recommend to do the Excel spreadsheets on all these calculations. Not only will it help you with your multiple choice questions, but it'll also help you with your case as well. Best of luck. Thanks for listening.